Today, my remarks will be shorter, my focus narrower, and my message more direct. The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions.
The President of the United States has already said that the sanctions the U.S. and its European partners have implemented are beyond this. Cutting the Russians off from Western finance generally and going after the oligarchs individually could have a much more significant impact.
China has used the drills in its military playbook to prepare for the invasion of Taiwan.
Are you willing to get involved militarily to defend Taiwan if it comes to that?
Yes.
You are?
That's the commitment we made.
America. Each morning for many of us is the start of a new day into a world driven by capitalism with daily commutes to work to drive the system or machine called the economy. The economy doesn't care about us. Its only purpose is to drive wealth into a system that has a thirst that's unquenchable for productivity.
The new law of evolution in corporate America seems to be survival of the unfittest. Well, in my book, you either do it right or you get eliminated.
A recession begins. You are out of work. Interviews daily, but still no job to provide milk or cereal. And searching for jobs has become quite painful, knowing the likely outcome. Relationship on the rocks, stress has reached an all-time high, along with inflation. But there is hope. Everything that has a beginning has an end, just as a cycle does, going from winter to spring. Join me, the Monk Investor, as we uncover the truth about recessions.
Now to the economy, and a critical question tonight as we face skyrocketing costs and higher interest rates. Are we at a turning point, headed for a recession? The president says not necessarily, but many others worry.
The point is, ladies and gentlemen, that greed, for lack of a better word, is good. Greed is right. Greed works.
We're going to jump right into it. This is SDS, ProShares Ultra Short. It's an inverse correlation with the S&P 500. What that means is if the S&P 500 is up, SDS is down. If the S&P 500 is down, ProShares is up. This is back in 2009. It was nearly $8,000 a share. And you may be wondering, why exactly over 3 years is it in the negative? That's because we were on a bull run for over a decade. And if you look at the 1 year, it's up 25% and change. Year to date, 53.09% SDS. And the reason SDS is up is because the market has been down all year. What I'm showing you right here is a way for you to make money using the bear method or inverse correlations. So what that is that when the market is down, this is your way to make money. You can do it through options trading or you could do it through stocks. And if you look here while I scroll down, going all the way back down to prior years, it was up. And the reason it was during 2008 and 2007, if you recall, that was during the times of high inflation, and also when the stock market, at the time, we had the housing crisis. So money was to be made during bear markets, and this is something you should be aware of. SQQ, Pro Shares Ultra Pro, Short QQ ETF. This is another ETF and another way for you to short the market. What that means, and I've mentioned this in prior videos, is a way for you to make money when the stock market goes down. So instead of you buying stocks when the market is up, this is a way for you to make money when the stock market is going down. This was an advantage and a tool that our past generations did not have. This was established in February 2010 by Pro Shares. Ultra Short QQQ SQQ is an inverse leverage exchange traded fund ETF that tracks the NASDAQ 100. The NASDAQ 100 is composed of the largest companies, both domestic and international, listed on the NASDAQ stock market, prioritized by total market capitalization, but excluding financial institutes. So what that means, everything on the stock market is fair game, except for financial institutions. The inverse leverage strategy for SQQ means it attempts to reproduce a daily investment result that is roughly opposite the daily performance of its underlying index, and then multiply those results by a certain factor. The stated objective of SQQ is to triple the opposite results of the NASDAQ 100. What that means is if the stock market is down 100 points, SQQ will be up 300% or 3 times that. So everything is magnified by 3. If you look at SQQ year to date, January 3rd, 2022 to October 13th, at the time this was printed, it's up 98.45%. Why is this up and the stock market down? Because it's an inverse correlation. So it's up $29.24 to make it 58.94. And the reason, once again, it's up is because when the market is down, this will always reflect the opposite of it. It's called an inverse correlation. So you, as a consumer of information, and those watching this video, I want to point this out so you always have the tools to play defensive. So SQQQ, or QQQ for short, is up. But with that said, SQQQ is not a long-term way for you to make money. If you look over the past 5 years, it's down 97.69%. And the reason it's down is because we've been in a bull market or bull run for over a decade. That means that the stock market was doing well for over a decade. So obviously this is an inverse correlation. It's obviously gonna do opposite of what the stock market was doing. So if you look at it from this perspective, over the last 5 years, it's been in the negative. But right now, the stock market is down. So this is an excellent time to use QQQ. But historically, you would not want to use this for a long-term position or a long-term tool, being that it's inversely correlated in 3x or 300% inversely correlated to the stock market. In layman's terms or dummy terms, pretty much this can have a negative reaction or opposite reaction of what you want. You only use this when there is an opportunity for the stock market to go down, or let's say a recession, a crash, or a depression. This is when you would want to break out and use this. QQQ is very liquid. That is one of the reasons I like it. And the reason I say it's liquid, what liquid means is high traffic. That means it's a high amount of people in it. That means if you bought stock in it, you're more likely to get in quicker. And if you sell, you can get out. So when you hear the word liquidity, that means that there's high traffic in it. If you look at the volume, it says 198.03 million people. And the average volume over 3 months is 130 million people. That means that the traffic in it averages over the last 3 months has been 130 million people. So there's high traffic in it right now because the market is down. And to break down SQQ's portfolio, if you look, 34%, 33%, 24%, 12%, all of those are mortgage-backed securities or they're banks. And some of it is United States Treasury bills. And the reason being is that most of what I named above, those are safe havens when the stock market isn't acting right. If you look at the net assets of SQQ, it's 5.13 billion. Year-to-date daily total return is 112.89%. At the time I made this video, it's probably up even more right now currently, but I just wanted to put that out there, that the reason SQQ works inversely towards the S&P 500, it's a safe haven. So you're going to see a lot of banks, you're going to see mortgage-backed securities, and you're going to see U.S. Treasury bills.
When you see around the globe the maldistribution of wealth, the desperate plight of millions of people in underdeveloped countries, when you see so few haves and so many have-nots, when you see the greed and the concentration of power within, did you ever have a moment of doubt about capitalism and whether greed's a good idea to run on?
Well, first of all, tell me, is there some society you know that doesn't run on greed? You think Russia doesn't run on greed? You think China doesn't run on greed? What is greed? Of course, none of us are greedy. It's only the other fellow who's greedy. The world runs on individuals pursuing their separate interests. The great achievements of civilization have not come from government bureaus. Einstein didn't construct his theory under order from a bureaucrat. Henry Ford didn't revolutionize the automobile industry that way. In the only cases in which the masses have escaped from the kind of grinding poverty you're talking about, the only cases in recorded history are where they have had capitalism and largely free trade.
During the 1970s, as inflation climbed, the anticipation of high inflation became entrenched in the economic decision-making of businesses and households. The more inflation rose, the more people came to expect it to remain high, and they built that belief into wage and price decisions. As former Chairman Paul Volcker put it at the height of the Great Inflation in 1979, inflation feeds in part on itself, so part of the job of returning to a more stable and more productive economy must be to break the grip of inflationary expectations. One useful insight into how actual inflation may affect expectations about its future path is based in the concept of rational inattention. When inflation is persistently high, households and businesses must pay close attention and incorporate inflation into their economic decisions. When inflation is low and stable, they are freer to focus their attention elsewhere. Former Chairman Alan Greenspan put it this way: for all practical purposes, price stability means that expected changes in the average price level are small enough and gradual enough that they do not materially enter business and household financial decisions.
Without public confidence, there is no central bank. Without public confidence, there is no system. Back in 1930s, you've seen a lot of mistrust for the banking institutions. And the reason being is that one day you could put your money in the bank and the next day it might not be there. That is why the FDIC was created, to protect your money. So the central bank's main objective is price stability and maximum employment. So the Fed and the committee seeks to achieve a maximum employment and inflation rate of 2% over the longer run. With inflation having run persistently below the longer run goal, the committee will aim to achieve inflation moderately above 2% for some time so that inflation averages 2% over time and longer term inflation expectations. Let's talk asset bubbles.
Now, during the Greenspan era, we experienced a period of asset bubbles. Here you have a boom that may be unsustainable and the possibility that people may have their savings wiped out and their IRAs and pensions disappear. Is part of the Fed's mission to keep a lookout to see that asset prices aren't artificially inflated?
Well, this is the big issue I really grappled with when I was writing the book, because one of the discoveries was that Greenspan, as a younger economist, writing a paper that became part of his PhD, said that the central bank ought to fight asset bubbles. If the stock market was overvalued, they ought to raise interest rates to squeeze that air out of the bubble, and before the bubble got even worse, reduce it so it became less dangerous. When Greenspan, on the other hand, was the Fed chairman, he did not do that. He neglected to fight the bubble in the technology stocks in the late 1990s. He did the same thing again, sat on his hands when the subprime bubble was inflating in the 2000s. So Greenspan decided not to fight bubbles, and I think that was a mistake. I agree, in other words, with the young Greenspan, who said the central bank should fight bubbles. I don't agree with the older Greenspan who didn't do it.
On January 29, 2020, Jay Powell strode briskly to the podium to begin the first press conference of his third year as chair of the Federal Reserve. He flipped open the white binder, looked up briefly to welcome the assembled reporters, and then looked down to read his prepared statement. His demeanor was low-key, almost somber, but his message was upbeat. The U.S. economy had entered the 11th year of a record-long expansion. 5 weeks later, that same podium, Jerome Powell walked into the same podium and in the same calm tone read a much darker statement to reporters. He offered his sympathy to people the virus had harmed around the world, noted that it had disrupted the economies of many countries, and predicted that measures to contain the virus will surely weigh on economic activity. That virus was called COVID-19. COVID-19 had changed the world dramatically, but what the world wasn't expecting was Vladimir Putin, the world leader of Russia.
Vladimir Putin has issued a warning of his own, with Russian oil sanctions now on the table.
The invasion of Ukraine would have a catastrophic effect on the global economy. Ukraine is known as the breadbasket of the world, so it caused world food prices to reach all-time highs, affecting everything in supply chain. Wheat, oil, sugar, meat, and milk had had a significant effect on world food prices that reached all-time highs in 2022. What if I told you that the world was dependent on Russia and Ukraine for wheat? The war between Russia and Ukraine had such a significant effect on the world that other countries that were dependent on Russia and Ukraine for wheat were affected. Dependency on Russia and Ukraine had become weaponized.
The Europeans feel the pain more than we do of sanctions. It is not without any collateral impact in their countries.
Food wasn't the only thing that rose during the Russia and Ukraine war. Gas prices soared nearly 300%. Being the investor that I am, I was able to capitalize on LNG, liquefied natural gas. I was able to position myself months in advance of Russia and Ukraine because I have an inside knowledge of what countries have this and what countries have that. In order to be a better investor, you have to know what country offers. I knew that Ukraine offered wheat. I knew that Russia offered gas. So I was able to capitalize on liquefied natural gas. There's other aspects to this, such as export bans. I knew coming into this that Russia invading Ukraine would cause significant damage to their economy. I knew that sanctions would be placed on export and import of Russia. So wheat wasn't the only thing that I was able to capitalize on. I was able to take advantage of the whole country of Russia. What I did was I shorted the whole country, RSX. That means that I knew that their economy would go down. So what I did was position myself in a March 11th, 2022 put. So what that was, I bet on the whole country to go down or place puts on it. And I was able to make some money significantly. This is my play account. This isn't all of my money. This is just a way to show you how I was able to place a put on the whole country of Russia, RSX. So that's a significant game. That's 2,137.44% in the middle, RSX. That's a whole country of Russia. If you're a stock trader, this won't make sense to you, but if you're an options trader, it will. I was able to hedge against the whole country and make a significant amount of money. And this is my play account. This is for visual purposes. So if you see there, the cost of it was $43 and I was able to buy 2. So that's $86 roughly, and I was able to make $1,872.40 off of it. So that's a significant gain from $86 due to my knowledge of understanding Russia and how this plays a part in war and economics. I don't want to sit around here and glorify war because war is such an ugly thing and it affects so many lives. But I was able to capitalize on the downfall of Russia. So my way of understanding this is from a macro and micro economic standpoint, such as trade. So I knew sanctions being placed on Russia would give me an advantage and give me leverage. So war can be ugly. Make no bones about it. War can be ugly. So the coronavirus had led us into a bear market. Then once the February 2022 Russia invasion of Ukraine came, that was a straw that broke the camel's back, but it was hardly the only contributing factor to the current global supply chain crisis. Back in 2018 and 2019, we were already going through trade wars in USA. The COVID-19 just pushed it into new territory, and it's continued to this day. And while the main focus should be on the tragedy of human loss and destruction of Ukraine, the Russia invasion has triggered sanctions and other obstacles that have hampered critical logistics and trade route operations. So what happened with Russia-Ukraine was significant. It's messed up supply chains and led to people not being able to eat and other factors such as starvation around the world. So it had a significant effect on a third of the world. The ripple effects from Russia-Ukraine not only has affected the global world, but China. China right now is dealing with COVID-19 still. It's had a significant effect on a lot of things, but especially chip shortage. Why are chips so important? Chips go into everything, such as your phone, your fridge, your car, everything. Semiconductor chips are so important, and they're costly. In case you're wondering how costly the effect of chip shortage was, in 2021, it cost the auto industry over $200 billion. That's billion with a B. So in 2021, it cost Ford, GM, Tesla, and many of the car companies that have electric vehicles over $200 billion. That's a significant amount. So COVID-19 and Russia, Ukraine has had a significant effect on not only just food, but semiconductor chips, which are important to all of us. But with that said, the semiconductor shortage has given us a chance to see which companies will come out above it all once this is all over. Ford's U.S. sales rose 27% in August on strong EV demand. So that was August 2022. So Ford is a company that I really like a lot. Most people, when they think of electric cars, they think of Tesla. But Ford as a company, I feel, is on the rise. In fact, I know Ford's on the rise because if you look here, 25.19, it was up $13.84 January 10th, 2022. What that shows you is that Ford, their U.S. sales rose 27% in August and rebounded from a year of production shortages and increased demand for electric vehicles. When you think of Ford, you think Ford Top. What you also think of with Ford is pickup trucks. And no other company can lay claim to owning the pickup market other than Ford. Not Tesla, not GM. It's been Ford. I have an intimate relationship with Ford because I've scored pretty well with them before in the past with nearly 450% and 944% on two options contracts. So I know them pretty well when it comes to the automobile industry.
Industrial plants build up arsenals of gas bombs, machine guns, and rifles. The sit-down strikes plague the nation. In Michigan alone, there are 51 strikes in 1 month.
The chances of charges ever being brought against the former president remain slim. And the reality is Donald Trump is as politically powerful now, if not more, than he was that fateful day in January last year.
Strikes are unpopular. Strikers will finally realize that labor cannot get very far if it makes itself unpopular with the bulk of the population in this country.
The struggle in the automobile industry will be fought to a finish. Labor will determine in this issue whether or not collective bargaining, in the accepted sense of the word, will be established in the automobile industry.
The Iranian regime has shut down the internet all across the country as it brutally cracks down on massive protests. Iran's military now issuing a chilling warning as the demonstrations escalate. The army calling the protesters enemies and threatening to confront them. The demonstrations erupted over the death of a 22-year-old woman. She died in custody.
Let's dive a little deeper into energy, the energy sector. That is one of the sectors this year that has been absolutely on fire. It's been a power play, to be honest. The euro slid below 99 cents after Russia halted gas supplies to Europe. What that means is Nord Stream 1 is a pipeline that cuts through European countries from Russia. So Russia supplies liquefied natural gas to European countries. The reason that's important is when the sanctions were placed, they were placed on Russia. So Russia was able to weaponize supply lines of energy to European countries. The reason they were able to do that is because of a company called Gazprom. So Gazprom is a Russian energy supplier that has key manufacturing pipelines, the Nord Stream 1 pipeline, and they've weaponized the use of energy. Nord Stream 1 is just one aspect of the energy crisis. The other is OPEC, which stands for Organization of Petroleum Exporting Countries. So they pretty much supply oil to the rest of the world. Let's take a look at China Energy again. This is LNG. So the liquefied natural gas that I spoke of with Nordic Stream 1, it's went up over the past year, $72.61 at the time that this was framed. So that was September 2nd, 2022. Let's take a deeper look at the current price of it now, which today's date is November 4th. It's went up at least by $10 to $171.78. APA is another company that's went up significantly over the year, $18.95, which is 95% return. Current price at the time was $38.80. Today's date, November 4th, $48.99. That's nearly $10 over the last month. The reason I point out these energy companies, you need to be able to move and find out quickly what other countries are supplying. This is how you depend on information and also history to guide you. So ExxonMobil up $40.51 at the time this was framed, and that was September 2nd, 2022. Currently, ExxonMobil is up $17.04, and today's date, November 4th, that brings the total up to $112.31. So energy has significantly increased over the year. Let's look at Constellation Energy, $81.07. That's $39.07 at the time, which is 93% on the year. Currently, Constellation Energy Corporation is at $94.32. That's up nearly $5 over the last month. So obviously, energy has continued to push up. Equinor ASA, $38.89. That's 75% up over the past year, and that was September. Exelon Corporation, same situation, $44.08, up this year, 23%. A significant increase for the energy sector. Because I have a background in nuclear reactor theory, I understand how nuclear plants operate and what the power industry means to them. So Belgium shutting down the nuclear reactor plant isn't good.
More and more heat will be developed in the core, the heart of the atomic furnace, without increasing its size. These are essential objectives in the effort to make nuclear energy fully practicable as a heat source for generating electric power. Consumers Power is one of 124 investor-owned electric utility companies that are paying nearly $750 million to gain actual working experience with this new fuel well in advance of the day when it will be needed. Looking ahead is not new for the electric industry. They must always put money into new plant and new techniques ahead of the need. And the Big Rock Point nuclear plant may well be one of the industry's most productive achievements. Nuclear fuel, as it is used at Big Rock Point, is very likely to become economically competitive with coal. That day, that tomorrow, may seem a long way off to us now. It isn't. Not in the technology of power production. Consumers Power knows this. They've invested money, time, and manpower to build a power plant for northern Michigan. They've invested money, time, and manpower to gain a head start on tomorrow.
Two minutes.
My fellow Americans, with summer coming, a lot of Americans will be driving more than ever. Going on See America First vacations and driving everywhere from New Jersey to California, and everything from vans to buses to motorbikes. This is a good time for it because gas prices continue to fall. In fact, they're falling as never before. When I first came into office in January of 1981, the price of gas was just about $1.25 a gallon. The price of a barrel of oil had reached $36. Americans were understandably frustrated and angry as they cast about for answers. Some people advocated more governmental intervention. Other people demanded gas rationing. Well, we said no. I didn't want to force more limits on people through rationing. I wanted to ease the situation by letting freedom solve the problem through the magic of the marketplace. Those opposed said decontrol would drive up the price of oil, increase gas prices, and cause terrible inflation. The price of oil has fallen from the $36 a barrel of 1981 to about $12 a barrel today. The price of gas has also plummeted from an average of $1.25 a gallon when I took office to about 82 cents today. In fact, the price of gas is now cheaper in real terms, meaning accounting for inflation, than it's been at any point since the 1950s. When I came into office, the United States was consuming about 17 million barrels of oil a day, 6 million imported. A big part of that oil came from the Middle East. Today, we consume less than 16 million barrels of oil a day, and only 4 million are imported. But what may prove to be even more significant is that we've changed who we buy our imported oil from. Back in 1981, most of it came from the OPEC countries. But now most of it comes from Canada, Mexico, the Caribbean, and Great Britain. What we have to do now is go forward with actions that will further improve our energy production, freeing up all remaining energy prices. That means doing to domestic gas what we did to domestic oil, decontrolling it.
As I mentioned before, many countries have looked to capitalize off the energy crisis. Someone will always be paid when there's a crisis for supply and demand of energy. Back in the 80s, they had gas rationing and there was limited supplies of gasoline. OPEC, Organization of Petroleum Exporting Countries. Here is a few of the countries: Algeria, Angola, Ecuador, Iraq, Iran, Qatar, Kuwait, Libya are some of the companies or countries that are designed to control the masses and control the influx and outflux of oil. All of these issues has led to oil prices per barrel being up at its highest level since 2014. Global GDP, gross domestic product, it's increased over the past few years, but this year it's been in decline compared to past years. And that's not just the USA, that's all around the world. Although if you look at this chart here, China and Mexico has had low inflation, while the US and Greece has had a higher inflation. China's GDP has been growing over the years, minus COVID-19 along with 2022. So that is showing you that times have changed. Although we made a recovery in 2021, it hasn't recovered like it should in 2022. As I mentioned before, GDP growth has been down across the board for all countries. It's even led to market turmoil. Signs of a recovering economy. In order for you to see the signs and understand them, sometimes you have to go back in the past to understand the future. So this is Warren Buffett. Many call him the Oracle of Omaha. He's a legendary investor and a billionaire. Let's listen in on 2008 and what his thoughts were.
I want to just go back to 2008 for a moment and just even start with a very big picture sense of it all. What do you think happened that led to 2008?
You had people think that housing could do nothing but go up, and you had a $20 trillion market in residential housing. So it was a big asset class, and people started using it as a currency, basically, and they found out that it wasn't straight up, in the end, and they borrowed on them, and there were levels of participation up and down the line. I mean, people at the top were writing mortgages that they knew they'd never have to hold, so they'd sell them to somebody in Norway after they'd been put in a package, and you had people refinancing, figuring that didn't make any difference whether the monthly payments were too high, and you had them lying on loans, and you had the lenders participating in it, and you basically just had a huge speculation in housing, and 50 million of the 75 million owner-occupied homes in the United States were mortgaged. 25 million were free and clear, so they were okay. But you literally had a crash in the value of something that 50 million families owned on margin, had thought were going to go up. They'd based their living standards on it. In many cases, they'd borrowed against it. And it was unlike any widespread financial participation anybody had ever seen.
It's early 2008. Hedge funds with a lot of subprime mortgages are going under. There were a couple. At that point, how worried were you? Do you remember being worried?
Well, I wasn't worried because I've always assumed that in a lifetime of participating in the American economy, it's going to move forward dramatically over time, and also it's going to have a lot of hiccups. And it's part of our economic system that we will periodically have some craziness go on. And so I don't try to predict markets, or I don't try to predict business. I just try to adapt to what comes along. I did see in the summer of 2008, I got a call from one of the top officials of one of the main Wall Street firms trying to sell us many billions of dollars worth of equity securities in Freddie Mac, and I knew something was wrong.
So take us back. I don't know if you remember this. This is after Bear Stearns goes down. So this is before Fannie and Freddie.
Yeah.
But after Bear Stearns, you get a call from Dick Fold.
Right.
And he tells you that his stock is getting killed by short sellers.
Yeah.
And
when anybody says that to me, I get very suspicious. I'd love to have short sellers in Berkshire. How does a short seller hurt you?
And he says there's an opportunity for you to invest somewhere between $3 to $5 billion. Are you interested?
I'm interested in hearing him out. Yeah.
And what did you tell him?
I told him, tell me what your ideas are, and I'll do some looking at it. But tell me what you'll pay first, and then I'll know whether I want to do some looking. And so he threw out some tentative ideas. So anyway, I spent that evening going through there, probably a 10K. I've got it at the office still, where I made notes as I went through it. And it was 250 or 300 pages. And I just wrote down on the front page the number of the pages where I was finding problems. And when I go through, I knew that it was not for us.
Because you saw what?
I just saw a lot of things that made me very worried about their financial condition and what would be happening to them under the circumstances that were happening in Wall Street.
Now we're in September of 2008. And this is Friday, September 12th. This is the weekend.
The weekend.
The weekend. And you get a call this time, not from Lehman Brothers, but from AIG, asking if you'd be interested in investing $10 billion in the company.
Yep. I said that, don't count on us. I know time is of the essence with you guys, so just don't waste it on me. So I'm out at that point. Now, they re-entered the picture a little later. But I said, I can't figure this thing out. It would have been 20-some billion dollars, and we could have paid it if I'd known what we were getting. Well, the very fact that they were calling me and sending out stuff Friday evening at 8 or 9 o'clock in New York indicated they were in peril. That was the prevailing view of at least one Fed chairman.
So you think the Fed could have done it if they wanted to?
I think if I were chairman of the Fed and I saw what was going on in the United States then, I think I would have done it whether I could do it or not. I mean, are they going to come down? The Supreme Court going to send down some guy to arrest me as president of the Fed? I mean, I would feel it would be an act that I should do in the interest of the country, if I were in that position.
So you think it was a mistake?
I don't know. I mean, because they'd have had to guarantee so much of public opinion. Can you imagine public opinion if all of a sudden, people are losing their houses and facing facing being underwater on and all kinds of personal problems, and all of a sudden you've guaranteed that everybody at AIG is going to be okay and everybody at Lehman's going to be okay. I'm not sure it would have been. It would have been very tough to do.
And you get a call later in the week about Goldman Sachs. Do you remember that call?
Well, I remember the call. Yeah. When Goldman Sachs needs money, you'll remember it. And I thought that there was Goldman Sachs was sound under any situation except if markets just totally were closed up.
Was there ever a moment that you thought that the system would gum up so much that people, that we would be back in sort of a Great Depression, that there really would be red lines and, people?
It could, if mishandled, it could have lasted quite a while. It wouldn't have lasted as long as then, but it would have really gummed things up. There's no question. They're already gummed up, but it would have, at some point, the government has to step in. When everybody in the world wants to deleverage, there's only one party that can leverage up. There's just one party. And if for some reason they don't do it, you've had it.
And when you look back now, is there a great lesson, you think, for the public, for new generations of people who are going to hopefully learn about and think about this crisis?
No, because the answer is people have always panicked. That's why they set up the Fed. We had all kinds of panics in this country in the 19th century. When people are afraid, they are afraid. Confidence comes back one at a time, but fear is instantaneous.
So it's a couple books I highly recommend, such as the economics book, along with Fundamentals of Power Systems Economics. Those are two books that have helped me along my path into learning exactly what a recession is, what GDP is, what inflation is, and all the things that come with it. Let's hone in on rate surge. So the Fed's rate that keeps rising has led to Treasury yields rising higher. What that means is it's a safe haven. So when money isn't appreciating, people head over to the Treasuries, the yields. Let's talk assets versus liabilities. So the Federal Reserve has a balance sheet. What the balance sheet is a commitment to transparency and its actions taken in connection with two of its key functions: conducting monetary policy to meet congressional mandate of maximum supply of money. So every major asset and liability has to be tracked on the Fed's balance sheet. What the asset sheet is the Fed buying mortgage-backed securities along with treasuries. So $8.5 trillion in the negative right now, or cash on hand. So that just means that assets versus liabilities, they have $8.5 trillion in liabilities. Yeah, 8.5 trillion, not billion, 8.5 trillion. In June 2020, the U.S. economy expansion peaked in February 2020, falling into a recession caused by the COVID-19 pandemic the next month. The economic expansion dating from June 2009 had lasted 128 months, surpassing the 120-month expansion from 91 to 2001 as the longest stretch of economic activity. So what that means is that the economy was doing well for over 10 years. Let's talk about the money supply. There is such a thing as money supply. That just means the amount of money that's in circulation. As tracked by a chart called the M2, it just means that the money supply that's circulating in the world. So let's say $100 is the world's currency or the world's amount of money in circulation. All 100 of the dollars need to be accounted for. So the more money that they increase is the amount of the M2 or cash on supply. If you look here at this chart, it's constantly been going up. So during COVID-19, when the pandemic happened, they increased the M2 supply all the way up. So you see that it's currently just increasing. And that just means that the amount of money that they printed out has led to inflation. If you look at this chart again, each gray line represents a recession, and you see them all the way from 1960 all the way to 2020, which was the shortest recession in modern day history. 2008 was pretty significant. That's when they started increasing the M2 supply. That's when that became a thing. So what that means is that they printed out more money than was needed. And when you have supply and demand both chasing each other, that creates inflation. The M2 has consistently went up. At the time this was created, it was at 20.5 trillion. It's currently around 21 trillion. The effect of money supply on the economy: an increase in the supply of money typically lowers interest rates, which in turn generates more investment and puts more money in the hands of consumers, thereby stimulating spending. Also, the opposite can occur. If the money supply falls, or when it does, growth rates decline. It's also led to inflation. This is a chart showing you that the years stocks have had bad years, it's also been an up year in bonds. So this is inverse correlations. Look at 1977, negative 7.2 in stocks, but 3% for bonds. That goes to show you that bonds becomes a safe haven when stocks and equities don't act right. It's easy to forget that the Fed rate for the longest was at 0% before they started hiking it up at 25 basis points, then 50 basis points, 75, and another 75, which led to 2.5%. So what that caused was a chain reaction. When you raise the Fed rate up, that increases the cost of borrowing on cars, homes, and everything you name it, including businesses. So with the Fed rate around 0, there was a lot of borrowing and currency reflected in the economy. So when rates continue to rise up, people are fearful. They don't want to borrow anything. I'm going to give you a history lesson. December 17, 2015. That was 7 years after 2008 global financial crisis before they started hiking up rates. Janet Yellen, who was the Fed chairman at the time, who's also the Treasury Secretary currently at the moment, she was in charge when that happened. So if you look, December 16, 2008, negative 100 points. That was detracted from the Fed rate. Then there was another decline of 50 basis points, another 50 basis points, taking it all the way down. So when the Great Recession officially began in December 2007 and lasted into June 2009, the Fed paused rate cuts between April 2008 and October 2008 as the global crisis deepened. So what happened was, during the financial crisis of 2008, the Feds decreased it all the way down to 0. And what happens when you decrease the Fed rate to 0? Like I said before, that increases borrowing. More people want to borrow when the rates are low. People don't want to borrow when the rates are high.
Dr. Friedman, is there an economic system now or historically that has allowed free enterprise alone to determine which direction the economy goes? And secondly, I have a three-part question.
Okay, fine.
Secondly, in economics you have resources, and how to best use these resources is a value judgment, but it seems to me you can have either free enterprise decide or government decide or some combination. And don't you think combination would be the best alternative? And thirdly, if I can remember it, isn't there some benefit to having the government steal our money, which is what they do effectively? They'll hold a gun to our head and say, pay us 40% of your income or go to jail. They take this money and they give it mostly to government employees. Well, the government employees spend it. The marginal propensity to consume is pretty high. So the people who were robbed have to do something creative to get the money back.
Let's suppose for a moment, take the extreme case, that 40% is being used just to have people sit around. The fact that they spend their money doesn't alter the situation. The only product there is what the 60% produce. And that 60% is divided among the 100%. If those 40% are also producing goods, then there are more goods to go around among everybody. You are just involved in a fallacy of looking at dollars, which is important sometimes, instead of looking at the real product, the goods and services that people produce.
So in 2008, they cut the rates down to zero, just like COVID-19. This was also the start of QE, or quantitative easing, which was the Fed buying bonds to stimulate the economy. So this was the first experiment back then with quantitative easing, which we've only really seen it done twice, 2008 and 2020. And that just means, once again, that the Feds are buying mortgage-backed security and bonds at an alarming rate. Right now, they're buying bonds at $120 million per month. That's quite a significant amount. So that just means that stimulates the economy. And if you want to stimulate an economy, the best way to do it is to inject money, print money, and cut the Fed rates down to zero. The reason I'm showing you all of this information and taking a blast back into the past is because I want for you to see how we got here. In order for you to understand how do we get back to where we once were, you need to go back in time and study the past. Let's go back even further to 2001, 9/11, when the dot-com bubble happened. As you can see in the red, plenty of negative BPS points, or basis points, negative 50, 25 basis points, 25, 50. So the amount of rate decreases or basis points that you're seeing now with the 75 is actually kind of unusual compared to the past. You've seen a lot of 25s and 50s, but you didn't see 75 too often, or 100. So in a 5-year period, you've seen the stock market rise 400%, and that was between 95 and 2000. That was a dot-com bubble, and that would end up with a lot of people losing their money and their life savings because of asset bubble. Alan Greenspan was the Fed chairman at the time of 1995. As you can see, rate changes up. So Fed rate changes that were increased due to monetary policy tightening. And this was the first time they tried soft landing, which basically means that you're going to try to land without tipping yourself into an recession. So 1991, 95, you've seen a lot of rate declines. I'm going to introduce you to the dot plot. This is an implied Fed funds target rate. So what this is just a brief estimate of where they expect the Fed rate to go. If you look on the left, you see it very high. You see it around 4.5, nearly 5%. That's the Fed funds rate. And then you slowly seeing it decline as the years go on. So you see 2022, 2023, 2024, 2025, and 2026. So that just means that when they bring the Fed rate up, it's going to slowly go down. And the reason they want it to slowly go down is to kill the economy or kill inflation. By killing inflation, they can slowly reduce it back down to where it needs to be, which is at the 2%, which is the neutral rate. 2% is the mark that Jerome Powell wants to get to. Many of my long-term viewers have asked me, when do I think that the economy will recover? What you'll usually see, you'll see an increase of the Fed funds rate. So you'll see it go all the way up, and then you'll see it slide over, and it's usually stagnant, meaning that it's going sideways. And then you see a slow, gradual decline. Then it's back at the 2% neutral rate. So if you see a 5% Fed rate, and then eventually you see 2% Fed funds rate, that usually means that companies are borrowing again and you see economic recovery. And it's a lot of things that go into this before you see a recession subside or GDP increase. But it's so many things that's involved, such as jobs, real estate, GDP, Fed funds rate. All of those have to correlate with one another for a recession or a GDP to go back to its normal cycle. There are three main reasons top central banks are unlikely to team up to arrest the U.S. currency strength. So you're seeing an increase in the U.S. dollar. That seems like it's a good thing on the outside, but you have to look at it from a macro and a global standpoint. If the value of the dollar is increasing, that means that the other world currencies are declining, such as the yen or the franc. So in 1985, the Paris Accord, or Plaza Accord to be exact, was an accord or an agreement that other countries came into agreement that the US dollar, they would purposely sink the US dollar down so that the value of it would make it more competitive to trade with the US. Because if you think about it, the US currency was increased in value. But if you're trying to trade beans over from another country such as France with the franc, it's going to cost you more to trade with the US. So you're seeing GDP declining because nobody wanted to trade with the US. So the solution was to come up with the Plaza Accord and decrease the value in the US dollar. You're not going to see that currently go on right now, but it is an option. They have done it before.
Good evening. I'm speaking to you tonight to give you a report on the state of our nation's economy, and regret to say that we're in the worst economic mess since the Great Depression. A few days ago, I was presented with a report I'd asked for, a comprehensive audit, if you will, of our economic condition. You won't like it. I didn't like it. But we have to face the truth and then go to work to turn things around. And make no mistake about it, we can turn them around. I'm not going to subject you to the jumble of charts, figures, and economic jargon of that audit, but rather we'll try to explain where we are, how we got there, and how we can get back. First, however, let me just give a few attention getters from the audience. The federal budget is out of control, and we face runaway deficits of almost $80 billion for this budget year that ends September 30th. That deficit is larger than the entire federal budget in 1957. And so is the almost $80 billion we will pay in interest this year on the national debt. 20 years ago, in 1960, our federal government payroll was less than $13 billion. Today, it is $75 billion. During these 20 years, our population has only increased by 23.3%. The federal budget has gone up 528%. Now, we've just had 2 years of back-to-back double-digit inflation. 13.3% in 1979, 12.4% last year. The last time this happened was in World War I. In 1960, mortgage interest rates averaged about 6%. They're 2.5 times as high now, 15.4%. The percentage of your earnings the federal government took in taxes in 1960 has almost doubled. And finally, there are 7 million Americans caught up in the personal indignity and human tragedy of unemployment.
Throughout 2022, there's been many opportunities to make money, especially with a declining S&P 500. If you're an options trader, it definitely should be easier for you to play defensive plays. And I have prior videos such as Bear Season 1 and 2, which is a series that teaches defensive maneuvers. So you were able to use SPY puts against the market and make money, such as right here, where $1,058 was made in a day on 83%, or $443 on SPY puts. There's many ways you could have made money in the stock market with QQQ or SPY, either or, which QQQ, as we discussed previously, is an inverse correlation to the stock market. So when the stock market goes up, QQQ goes down. And always keep a broad view or overview of the stock market. If you're a long-term investor, you should always zoom out. Don't just zoom in. And what I mean by zooming out, that just means that this chart right here currently shows that the stock market is always going up. It might not look like it if you look at it on a day-to-day or week-to-week or month-to-month. Just zoom out and look at it over the last 50 years. The stock market is always going up. So if you're a long-term investor, hold on to your stock. Those should be long-term positions that you're buying. If you have Apple, you should be keeping Apple for 5 to 10 years, 15, sometimes 20. And once you accumulate enough stock value, that's when you shave some off the top. You don't have to keep it at where you bought it in at. So if you bought it for $10 and it's up to 50, shave some off the top. Let's take a look again at the United States inflation rate, or CPI core price index, or consumer price index. United States GDP year over year has continuously been in decline, the GDP, versus inflation, which has increased. And also Greece too, not just US. A lot of global trade partners have had a decrease in their GDP. Taiwan, a small island off the coast of the Pacific near China. Taiwan, home of 24 million people, and it's 14,000 square miles. Taiwan Strait, that's 100 miles from China. That is the middle portion in between China and Taiwan. China has been exercising missile testing just to scare Taiwan. The people of Taiwan have been upbeat about it, but if war was to be induced, this would have a significant effect on global economies, because Taiwan has semiconductors and chips. That is what makes Taiwan dangerous to the world. TSM, Taiwan Semiconductor Company, is one of the world's largest and greatest semiconductor companies. So if semiconductor chips were to get in the wrong hands, such as China, it could be devastating. These are some of the things we need to think about going into 2023 that could have a significant effect on the global economy.
To master a variety of different technologies, and semiconductors is really core among all of them.
Constantly re-examine what you're doing wrong, and you slowly you tentatively get things right, but you can't really get the dynamic going until you have a little profit under your belt, because it's very different when you're risking your principal than when you're risking your profit. So that's how you get these runs, when you get it right, and then you can risk more and make more money. When you have lost it, when you're doing poorly, you've got to retrench.